More finance news with me Miami Sky Pages and this Mangusta 94. Stay tuned.
Well, I've been in the business for about 20 years, and I've seen a tremendous number of changes within those 20 years. At the beginning of my career, some of the best and talented money managers could extract alpha, that's excess return, from the equity markets above 10% per year. Today, that alpha is zero, if not negative. So just in the last 20 years, we've seen a tremendous number of change. Let's think about why that's happened. Technology, data, the ability for investors to get news in an instant. These are all factors that have had a tremendous effect on the ability for investors to extract excess returns from the market. Well, we've seen a revolution in data and news over the last decade. We have Facebook, Twitter, LinkedIn, on-demand news. These have had tremendous effect on the emotions and the behavior of investment participants. Okay, so the problem with abundance of news doesn't necessarily mean there's a high quality of news. So at Bodhi, and what I've learned over the years is to really distill the most important parts of the news into what I think are the 3 to 5 most important factors that drive particular assets. And I suggest that for many investors, they do the same. Well, I'm a huge fan of automatic investing. And the reason is that over the years, if you analyze the best investors, they all have what is called a repeatable process. In fact, that actually applies to entrepreneurs as well. Is your process for investing or running a company, can that be replicated over and over again? The irony, though, is that in a world of data and technology, processes that can be replicated are ripe for automation, okay? And so, that provides an interesting conundrum, because in the past we were used to having an investment advisor, a human being kind of guide us through investing. But if that person really did have a good process, you should be able to replicate it vis-a-vis an algorithm. And that's exactly what a number of these new companies and upstarts have done. High net worth investors, have a much wider variety of options to invest, much more sophisticated strategies that can oftentimes beat, using the chess and checkers analogy, we can think of more basic pedestrian automated programs as checkers. But the sort of programs that Bodhi tries to put in its portfolio, we liken it more to chess, much more complex investing styles. We recently did an interview with Bloomberg where we talked about the utilization of ETFs in hedge funds. That was something that was not nearly as prevalent even a few years ago as it is today. One of the reasons is that the ETF space has evolved tremendously. It actually embodies this utilization of data and technology in many ways. Because like I said, if a process is good and it can be replicated, you can turn it into an algorithm and therefore even potentially an ETF. And what I have found is that these ETFs are incredibly disruptive to traditional investment styles. Something that a high net worth investor might have paid a very high fee for in the past can be accessed in a liquid, very transparent vehicle today. I find that to be incredibly compelling, and so where I focus a lot of my work is understanding these instruments and really how to use them in the most optimal way based on the economic cycle. We think that we're in a new paradigm in terms of what investors should expect as a return from their investments. It's going to be much more difficult, I think, over the next 10 years to make excess returns from investing versus the past 10 years. It's been an incredible 10 years. And I think that that's going to have profound implications on investors' asset allocations and maybe even the investment advisors they seek out. Thank you for having me, and I look forward to seeing you next time.
Vive Miami.